Hi everyone. So today we are going to start our new playlist which is on macroeconomics. It carries 3 marks as per revised IBBI syllabus. We'll try to cover this playlist into 3 sessions. So today is going to be our first session. In today's session, we are going to cover money and its functions, value and forms of money, inflation stages, types, causes, effects of inflation, measures to control inflation, measurement of inflation, deflation, causes, its effects. Then towards the end of the session, we will discuss about measures to control deflation, and we will also discuss about inflationary gap and deflationary gap. Sometimes 1 mark theory question comes out of this single slide only. So this is the full syllabus of macroeconomics as per IBBI exam curriculum. Though macroeconomics is a full-fledged topic and it cannot be covered, into 1 or 2 or 3 sessions, but we will try to focus on this macroeconomics topic from the perspective of clearing our IBBI examination. So we'll try to have a focused approach toward this topic. So first, most important terminology which we will come across throughout our macroeconomics session is money. So what is money as per macroeconomics? Money is anything that is generally acceptable as a means of exchange. So keywords are means of exchange. It has general acceptability as a means of payment and liquid characteristics. So this liquid characteristic is defined as liquid preference by Keynes. So these are the 2 important functions of money. Money has many functions and the same can be broadly classified into 2 broad categories. So these 2 type of functions are very important from examination perspective. So first set of function could be categorized into static function category, and second set of functions could be categorized into dynamic functions category. Let us discuss each of these 2 categories. What are these functions all about? So first is static functions. So these are traditional functions basically, and without these functions the economy of country cannot work. So in static role, importance of money lies in removing the difficulties of barter systems. How it removes difficulties of barter? By providing medium of exchange. So money removes the need for double coincidence of want, as money can be used as a medium of exchange. So if I am growing wheat, you are growing banana. Until unless I don't need banana and you are also in need of wheat, we two cannot we cannot exchange, we cannot barter our goods, banana and wheat, until unless both of us have need of each other's item. So if somebody else is growing, say apple, say third person is growing apple, and I want to buy apple, and the farmer who is growing apple, he want to buy banana, and the farmer who is growing banana, he want to buy wheat, then there is a difficult process into barter system. So with the availability of money, so that exchange is easily possible. So it can be used as a medium of exchange, right? Second static function is measure of value. Being a unit of account, money can becomes a common measure of value. Things are said to be cheap or expensive on the basis of amount of money required for their possession. So if there is no money, so I may say that for 1 banana I may charge you 1 kg of wheat, right? So I may my 1 kg of wheat, if you want 1 kg of wheat, that might be equivalent to quarter banana. That is not practically possible to take quarter banana from you. It will be a little bit difficult. So it is always difficult to under barter system to define the value of each item. But with the availability of money, we can define the actual value of a good. So you can define which item is to be expensive, which item is to be cheap with the help of this money. So money help us in measuring value of each item. Third important static function is standard of deferred payment. It implies role of money in borrowing and lending. So money borrowed is to be repaid after some time in the form of money. Store of value. Purchasing power of money can be stored by keeping a part of it as saving for future consumption. So if I grow banana, I cannot preserve bananas for future consumption, maybe after 5 years, 10 years. But if I sell those bananas and convert those bananas in the form of money, I can preserve that money into my account for say 10 years or 20 years. But bananas I cannot preserve. So I can store my value in the form of money. I can store my purchasing power. So these are the dynamic, there are also some dynamic functions. So they are those functions which cause movement in the level of economic activity in a country. So in its dynamic role, money plays an important part in daily life of a person, whether he is a consumer or a producer or a businessman, an academician, or be it politicians or an administrator also. So how does it play a role in, for a consumer? To the consumer receives his income in the form of money rather than in goods and services. The person who is buying goods in the market, he receives, he's doing some job and he is getting some money, right? Some his income from the employer in the form of money, and he can use that money to purchase goods and services from the market. That is why he is consumer, right? For if we talk about producers, with money the producer can keep his accounts, that is value of inputs and outputs of production. So as a producer, if I use money as a medium of exchange, then I know that whatever raw material I have utilized, for example, I'm a manufacturer of TV. I may require to buy picture tube, LEDs, electric wires, and other items also. Labor would also be required. So I can keep a track of all those expenses which I incurred on various type of inputs, material and labor both, required to produce that good, that TV. And on that production cost, I can keep some margin and decide on price of the product. As a basis of credit, all modern businesses are based on credit, and credit is based on money. That is the third function basically under dynamic category. So all monetary transactions consist of checks, drafts, bill of exchange, etc. And these are credit instruments which are not money. Please note down that all these monetary transactions which include check, draft, bill of exchange, so these are credit instruments. Never get confused with money, because this 1 mark theory question may come out of these 4 lines only. As a mean of capital formation, when savings are converted into investments, money acts as a mean of capital formation. For example, saving kept in bank account earns interest income. As an index of economic growth, the various indicators of growth like growth in national income, per capita income, and economic welfare, etc., are being represented in money. That is another function of dynamic function of money. Then in the distribution and calculation of income also, how does it work? The rewards of various factors of production in modern economy are paid in money. A worker gets his wages, capital gets his interest, a landlord gets his rent, and entrepreneur gets his profit. All these factors get their income from the production in the form of money. In national and international trade, money facilitates national and international trade. The use of money as a medium of exchange, as a store of value, and as a transfer of value has made it possible to sell commodities not only within a country but also internationally. In solving central problems of an economy, money helps in solving these central problems of an economy. For example, what to produce, for whom to produce, how to produce, and in what quantities to be produced. To the government, money also facilitates the government in collection of taxes, fines, fees, services given by government to the people. So let us now talk about value of money. It is the purchasing power of money, that is quantity of goods and services which can be purchased by exchanging 1 unit of money. This is the definition of value of money. Please note down this definition. Sometimes 1 mark theory question comes out of it only. Value of money is inverse of price of goods. Higher the price, lower the value, or lower the purchasing power, lower the value. When price level increases, the value of money decreases, and vice versa. So if goods will become expensive, the purchasing power will reduce and value of money will also decrease. However, if price of goods will decrease, goods will become cheaper. With a given set of money, I will be able to purchase more goods. So my purchasing power will increase and value of money will also increase. So next important topic from exam perspective is various forms of money. Many times a 1 mark theory question come out of any of these forms of money. So please do remember all these forms of money. So first type of money or form of money is cash money. What does it mean? It refers to money in physical form, like we keep in our wallet, which also include type of legal tenders such as bills and coins. Second type of money is form of money is credit money. It is monetary value created as the result of some future obligation or claim. So if I have given you some loan to you, so you owe that money to me. So that future obligation is credit money, basically. Metallic money. All sorts of commodities, including gold and silver, have been used as money at one time or another. Please remember this definition. This is very confusing. With metallic money, people presume that it is only gold or silver. However, it is all sorts of commodities which have been used in money at one time or another. Paper money. Goldsmith and banks used to issue a paper backed by precious metal. It is a promise to convert the paper into precious metal on demand. This is also very confusing. Please remember this precious paper money form definition. Fiat money. It is today's money issued by government. It is a legal tender or a settlement of all debts. This is also very important. Fiat money. Sometimes this 1 mark theory question comes for on fiat money also. Bad money. Money which has lower commodity value than its face value. And last one is good money. Its commodity value, if commodity value is almost equal to its intrinsic value, it is called good money. This is also another set of money, types of money. And many times theory question comes out of it. Sometimes numerical also come, but normally theory question comes out of it. These M1, M2, M3, M4 money. So let us understand. So M1 money is also called narrow money. Please do remember, if M1 money and narrow money, both are one and same thing. It is the money supply that is composed of money held with public, that is physical currency and coin, plus demand deposits with bank, plus other deposits with RBI. So put together, this is M1 or narrow money. And second type of money is M2 money. It is M1 money plus near or quasi money. So what does this mean? This near and quasi money. What is the meaning of this thing? Near and or quasi money, both are one same thing, are assets which can be readily converted into cash. For example, cash deposits, saving accounts, T-bills, money market accounts, etc. Please note that M2 money is less liquid than M1 money. Do remember this line. Many times this question is also being asked in IBBI exam. Third type of money is M3 money. It is nothing but M2 money plus term deposits of public with bank. And fourth type of money is M4 money. It is nothing equal to M3 money. This M3 money plus post office saving. Please note that M1 and M2 money are also called narrow money. However, M3 and M4 money are called broad money. So put together, sometimes M1, M2, these combinedly also called narrow money, and this M3 and M4 are called as broad money. So next important topic is inflation. So it is the increase in the general price level of goods and services in an economy over a period of time. So this is the definition of inflation. Inflation reflects a reduction in the purchasing power per unit of money. The inflation can be subdivided into, broad categories. These 5 categories are there. First is deflation, then hyperinflation, stagflation, recession, and depression. So let us understand each of these 5 stages. So deflation is when general level of prices is falling. This is opposite to inflation basically. This slide is very, very, very important from exam perspective. Many a times it has been seen, theory question comes out of it only. This definition, hyperinflation. This is unusually rapid inflation. In extreme cases, this can lead to breakdown of a nation's monetary system. For example, in 1923, in Germany, prices rose by 2500% in 1 month. That was a classic example of hyperinflation. Third stage of inflation is type of inflation is stagflation. It is a situation where economy experiences increase in inflation along with decrease in output and employment level. That is stagnation in economy with inflation. So this is the stage wherein there is a stagnation in economy with inflation. The economy is stagnant, however there is inflation in the market economy. And fourth type of inflation is recession. If GDP of economy declines for 2 or more consecutive quarters, only then it is called recession. If GDP is down for only one quarter, it is not called recession. Please do remember. So for minimum two or more consecutive quarters, GDP of economy should come down. Only then type of inflation the economy, it can be announced that recession has come. Depression, it is a severe form of recession. It happens when GDP falls at least by 10%. Let us now try to understand what are the different types of inflation. So, these type of can be broadly classified into two set of classification. First set of classification is on the basis of cause, and second set of classification is on the basis of speed of inflation or intensity of inflation. Each of these 9 terminologies is very important from examination perspective. So we'll discuss each one of them one by one in subsequent slides. So what is currency inflation? It is caused by printing of currency by government. Credit inflation. To make more profits, banks tend to sanction more credit to the public than that of what the economy needs. Such credit expansion leads to a rise in price level and leads to the inflation which is caused because of this inflation or this effect, this factor, this type of action by government or banks is called credit inflation. Then deficit induced inflation, when government expenditure exceeds its income. Income is 100 rupees, expenditure is 200 rupees or 150 rupees. There arises a deficit. To meet the deficit, the government may ask central bank to print additional money, and inflation caused due to this action is called deficit induced inflation. We are not deep diving into all these terminologies because examiner never ask very deep questions out of it. However, you should have an overview of this terminology. That is why we're discussing only basic terminologies. Then fourth type of inflation is cost push inflation. It is the inflation caused by increase in cost of any of the 4 factors of production. This we already discussed in macroeconomics series, which is already given, link is given in the description box below. So it is the inflation caused by increase in cost of any of the 4 factors of production. We already know what are the 4 factors of production as discussed in microeconomics: land, labor, capital, and entrepreneurship. Then fifth type of inflation is demand pull inflation. If demand for goods and services Rise is faster than supply of goods and services. Demand is say has been increased from 100 to 200. Supply get increased from 100 to 150. So rise in demand is more than rise in supply of goods and services. Some of the main causes of this inflation are excessive foreign investment, expansionary fiscal policy like increase in government expenditure, expansionary monetary policy like increase in money supply. We'll discuss all these things in subsequent sessions. Easy access to credit, deficit financing, etc. The next type of inflation is creeping inflation. This type of inflation occurs when the price level increase at a small rate but on a continuous basis, leading to mild rate of inflation over a period of time. It is also called mild or moderate inflation. Do remember, creeping inflation, mild inflation, moderate inflation are one and same thing. Galloping inflation, it is a very rapid inflation which is almost impossible to reduce. For example, 2 or 3 digit inflation, annual inflation, maybe 15%, 50%, 100%. Hyperinflation, in case of excessive deficit spending financed by printing of more money by a government, social breakdown may lead to hyperinflation. Say inflation is 50% per month, not per annum, it is per month, is called hyperinflation. Its roots lie in political rather than economic causes. Please do remember this line also. Hyperinflation is normally caused due to political factors, not due to economic factors. Suppressed inflation. Sometimes government try to control prices by measures like subsidies, etc., leading to suppressed inflation. So such suppression can only be temporary because no government measure can completely control accelerating inflation in the long run. It is also called repressed inflation. So suppressed inflation and repressed inflation both are one and same thing. So next is inflationary gap. It is a macroeconomic concept that measures the difference between the current level of real GDP and the GDP that would exist if an economy was operating at full employment. So assuming 100% employment in the economy, if say my GDP was 100, say 200 GDP. However, considering actual level of employment, my GDP is at 180. So the gap between 200 and 180 is called inflationary gap. Thus, it is the amount by which the actual aggregate demand exceeds aggregate supply at a level of full employment. Please remember this terminology, inflationary gap. Let us try to understand what are the various effects of inflation. So effects of inflation may be different for different groups as under. For creditors and debtors, creditors are generally worse hit because the real value of their future claim is reduced to the extent of the rate of inflation. On the other hand, in case of inflation, debtors tend to pay less in real terms, thus they tend to gain. Thus it could be said that inflation favors debtors at the cost of creditors. Please remember this line. Inflation favors credit debtors at the cost of creditors. So if we'll talk about what are the effects of inflation on salaried person, salaries of white collar jobs normally take time lag to adjust to the inflation. The salaried persons normally lose in case of inflation. So for salaried employees, normally inflation tend to rise first, and after some time lag, maybe 3 months, 6 months, or 1 year, government announced DA and then employer increases salary to meet out that inflation part. So salaries tend to increase with some time lag. Wage earners, if unions are not strong enough to ensure that wages are linked to the cost of living index, laborer tend to lose with inflation. Fixed income group, recipients of fixed interest, rent, annuity pensions, unemployment insurance tend to lose with inflation. For equity holders and investors, with inflation, businessmen tend to gain. Please do remember, because they get more profit as stock in hand and prices of finished goods tend to be higher than that of their input cost. Since businesses gain more profit, equity holders also gain more profit in case of inflation. However, investors carrying fixed return investment tend to lose with inflation. Please do remember this line also. Never get confused that investors holding equity tend to gain with inflation. However, investors carrying fixed return investment tend to lose with inflation. If we talk about agriculturists, so agriculturists could be of three types. Landlords normally lose during inflation because they get some fixed income. Peasant proprietors who own and cultivate their farms gain during inflation because prices of farm produce increase more than that of the cost of production. Rent remains constant, or it gets increased for some time lag. But cost of market price of the farm produce or agriculture produce tend to increase immediately in the market. Landless agricultural workers are losers during inflation as farm owners avoid to raise wages of the agri labor, or there exists some time lag. And then last effect on government is government will have both positive and negative effects of inflation. With inflation, real value of each rupee collected as tax or fine etc. tend to reduce. However, inflation lead to more money measurement in the market, leading to more collection of taxes in absolute terms. So in addition, there are some other general effects of inflation. So inflation affects the overall pattern of production. Manufacturers tend to produce more luxury goods than consumer goods. That is, production pattern shifts from consumer goods to luxury goods. Inflation also discourages entrepreneurs in making new investments because of uncertainty about future purchasing power of money, which discourages investment and saving. So with inflation, my purchasing power of the overall consumers will go down. With given set of money, consumers will tend to buy less items. So demand will decrease in terms of units of production, units of goods or services. Inflation also results in black marketing because sellers may stock up goods for selling in future, anticipating higher prices to milk out more money. Then people having fixed income get lower standard of living with inflation. So retired person having annuity income, or persons who are dependent on fixed interest income on the FDs, their interest will remain constant, inflation will rise up, then they will get less purchasing power and their standard of living will come down. Inflation adds inefficiencies in the market and make it difficult for companies to budget or plan long term. So if the company has planned say 100 crore rupees of investment till March next year, but with that 100 crore rupees of investment, the purchasing power has come down. So company either may require to put in extra money or may cut down the expenses. So government incurs high fiscal deficit due to decrease in value of taxes collected. So it also has adverse impact on taxes collected by government, and real value of taxes collected gets reduced because of higher inflation. Then on exports and balance of trade, with higher inflation than other countries, it's a relative thing. Exports decrease and import increase. This lead to deficit in balance of trade. Please do remember this terminology. As inflation increases, if inflation in India is 10%, and say in America it is 5%. So because of that higher inflation as compared to any other country, say America or China, any other country, then export will decrease and import will increase because goods from India will become expensive. So their demand will decrease in foreign countries. However, the goods which are outside are being produced in other country, because of less inflation in those countries, their relative value will come down, and people in India will tend to buy more goods which are cheaper and being imported from other countries. So demand for imported goods because of their lower price will increase. However, demand for Indian goods in other countries will decrease because of higher price. So this will lead to higher balance of trade. So it is difference between export and import. Then currency exchange rate. With reduced exports and increased imports, currency exchange rates get adversely affected with inflation. So if India is doing less exports, that means demand for Indian currency will come down. However, if India will increase its imports, then demand for other currency will increase. So obviously, since demand for Indian currency will decrease as compared to demand for other currency, so obviously the value of exchange rate of Indian currency will come down with increase in inflation. So these are the few measures to control inflation. Inflation appear due to mismatch between demand and supply. Thus, inflation can be controlled by increasing the supply of goods and reducing money income. The various measures to control inflation are as under. The three set of measures are there: monetary measures, physical measures, and other measures. Let us discuss all these three set of measures one by one in upcoming slides. So first is monetary measures. These measures aim at reducing flow of money in economy or reduce money income. So it can be done through credit control. RBI may put credit control by raising bank rates like CRR, SLR, etc., selling securities in open markets, and other selective credit control measures. Demonetization of currency of higher denomination. It is usually adopted when there is a abundance of black money in the economy, like it was done few years ago in India also. Issue of new currency. One new note is exchanged for a number of old currency. This measure is normally adopted in case of hyperinflation in economy. So after monetary measures, next set of measures is physical measures. So monetary policy alone cannot control inflation and should be supplemented by physical measures like reduction in unnecessary expenditure. Government should reduce unnecessary expenditure on non-development activities to curb inflation. Then increase in taxes. Existing tax rates should get increased and new taxes should be levied. These taxes should not be too high as to discourage saving, investment and production also, please remember. Increase in saving. Government should encourage people to save more. This would reduce their existing purchasing power. Then surplus budgets. Government should give up deficit financing and instead should have surplus budgets, that is collecting more in revenues and spending less. And fifth is public debt. Government should borrow more money from the market to reduce money supply with the public. So government should take out more money from the market either by borrowing from the market. Repayment of already borrowed money by government from public should be deferred. So ultimately money should money flow should get reduced in the market through physical measures. And this is there are other some few measures which are being categorized into third set of category are also called other direct measures. So these other measures are to increase aggregate supply and reduce aggregate demand directly. So this is to increase production. Government should encourage the production of essential consumer goods like food, clothing, kerosene oil, sugar, vegetable oil, etc. Then rational wage policy. Government should follow rational wage policy, that is to link increase in wage to increase in productivity. This will have a dual effect. It will not only control wages but also at the same time increase production of goods in the country. Then price control, fixing an upper limit for the prices of essential consumer goods to control the inflation. And fourth is rationing. Rationing aims at distributing scarce goods like wheat, rice, sugar, etc., so as to make them available to a large number of consumers. So that wealthy people should not be able to hoard or accumulate these essential items, and it should get distributed among all each other. That is why rationing is required to control the inflation. So these are the measures of inflation. Inflation is measured by calculating the percentage rate of change of a price index, which is also called inflation rate. So inflation rate is normally measured in terms of WPI, which is also called Wholesale Price Index, full form of WPI, and Consumer Price Index, CPI. Let us see each one of them individually. Wholesale Price Index measures the changes in price level of commodities that flow into the wholesale trade intermediaries. However, CPI is related to the cost of living of a specific group of population. Please do remember, CPI is related to the cost of living of a specific group in population. CPI is based on changes in retail prices. WPI is based on wholesale prices, changes in wholesale prices. However, CPI is based on changes in retail prices of goods and services. Thus, they are different consumer price indices. Each index tracks the changes in retail prices for different set of consumers. Deflation, already discussed that it is a situation when the general income level and price level are falling. So during deflation, income level falls against the available supply of goods. So here, income level falls. So these are the main causes of deflation. Demand for goods and services decrease. People start more saving than in past. If investments in economy fall than in past, demand for capital goods fall and prices will tend to be down. Decline in income of people, and last is excess supply due to some reason. So these are the major effects of long deflation. Number one, cyclical unemployment. Reduced demand lead to low production, leading to layoffs by the companies. Second effect is bankruptcies. Businesses with low production find it difficult to meet their liabilities due to reduced profits. This leads to bankruptcies of business again. And third one is deflationary spiral. As unemployment increases, salaries decrease, thus disposable income of people further decrease, leading to further loss of demand. Let us see how deflation can be controlled. RBI reduces interest rates, leading to reduction in ROI on loans. With credit expansion, demand for capital goods increase, leading to more employment and higher salaries. This lead to higher demand. Deflation can be controlled through this. Then government has to increase expenditure to boost demand. Government spending should be increased. Government RBI to print extra money and inject in economy, leading to price rise and increase in demand. So it is opposite to inflation. In case of to control inflation, we had reduced supply of money, and to control deflation, we have to increase money supply in the market. Motivating private sectors to make more investments by providing them subsidies, taxes relief, and people should start their saving spending on consumer goods and investments. Increase exports and decrease imports. Deflationary gap, it is the difference between the output assuming full level of employment and actual output. I repeat, deflationary gap is nothing but assuming 100% of employment, what was the expected output, say 100 minus actual output, say it is 80. So deflationary gap is 20 here in this case. So thank you very much for watching first session of current playlist, which is on macroeconomics. So before I'm going to tell you what we are going to have in our next session, second session of the second playlist, current playlist, macroeconomics, I would again request you to please subscribe to this channel, click on bell icon if you have not done till now, so that you will be immediately notified about the upcoming sessions as I upload it on the channel. So in next session, we are going to discuss in detail about savings, investments, then where are the various types of savings, determinants of savings, investments, types of investment, determinant of investments, and the relationship between saving and investment. 1 mark theory question is must out of this session number 2. So please catch on this, and third session we will discuss about the remaining part of the macroeconomics. Thank you.